So hey, welcome back to Trade Tactics. In today's video, I'll share with you the 3 best candlestick patterns that can help you take profitable trades. Without wasting any more time, let's start the video. Our first pattern is the engulfing pattern. This pattern appears on the chart in the following way and comes in 2 types: bullish engulfing pattern and bearish engulfing pattern. The formation of a bullish engulfing pattern is as follows. The first candle is a small red candle, followed by a large green candle that completely engulfs or covers the previous candle. This is a bullish pattern, and after it forms, there's a possibility of a bullish trend in the market. Remember, a bullish engulfing pattern is only considered valid when it forms during a downtrend. Now, let's look at the formation of the bearish engulfing pattern. As the name suggests, it's a bearish pattern, and after it forms, there's a possibility of a bearish trend in the market. In this pattern, the first candle is a small green candle, followed by a large red candle that completely engulfs the previous one. Keep in mind, this pattern is only valid when it forms during an uptrend. When a bullish or bearish engulfing pattern appears on the chart, don't take a trade immediately. Combine it with other price action methods like support and resistance for second confirmation. Let's understand this better with an example. Here, you can see the market moves up, takes a small pullback, and then moves up again before creating support at this level and continuing upward. This level becomes a support level. Next, you see the price comes back to this level and forms a bullish engulfing pattern. However, you shouldn't take a trade immediately. If the next candle is green and breaks the high of the previous green candle, you can enter a buy trade here. Let's look at another example. Here, you can see the price gets rejected multiple times at this level and moves downward, making it a major resistance level. Then the price returns to this level and forms a bearish engulfing pattern. Still, you shouldn't take a trade immediately. If the next candle is a red candle and breaks the low of the previous red candle, you can enter a sell trade here. Our next pattern is the hammer. This pattern looks like this on the chart. It's a bullish candlestick pattern and can be of 2 colors, red or green. Let's understand its formation. The hammer has a small body and a very small or no upper wick. Its lower wick is at least twice, or more than twice, the size of its body. Remember, a hammer is only valid when it forms during a downtrend. Let's understand this better with an example. Here, you can see the market is in a downtrend. Next, we spot a hammer pattern. However, don't take a trade yet, as there's no second confirmation through a support level. Later, the stock price rises slightly, then comes down again and forms a hammer at the same support level. Now we have a hammer and a previous support level. Still, don't take a trade yet. Wait for the next candle to form. If the next candle is a green candle and breaks the high of the hammer, you can enter a buy trade here. Our next pattern is the hanging man. It looks very similar to the hammer, but the difference is that a hammer forms during a downtrend, while a hanging man forms during an uptrend. Here you can see the market is in an uptrend. The price gets rejected multiple times at this level and moves downward, making it a key resistance level. Later, the price returns to this level and forms a hanging man pattern. There's a possibility the stock price may drop from here, but don't take a trade immediately. Wait for the low of this candle to break. If the next candle breaks the low of the hanging man, you can enter a sell trade here. Some important points to remember. The larger the lower wick of the hammer pattern, the better. Hopefully, you found this video informative. If you did, please like the video and subscribe to the channel. See you in the next video. Until then, best of luck with your trading journey.